Alright guys, DGOC update today, so I don't need to tell you which channel this is. This update got uploaded today, a few hours ago, and it's an exciting one, so I thought I'd take you through it today. So let's get right to it. This is a bunch of text. I'm not gonna lie, there was a lot of text in this update, but two things that you should really take away. First, to acquire certain upstream and midstream assets from a US listed oil and gas company. Unfortunately, they do not name the company because it could be nice to know, and then maybe it's a publicly listed company. It would be nice to acquire that company as well for a short period of time. And that's one. And then the second is a similar announcement on 8th of April, and I already made a video about that, on the conditional purchase and sale agreement with Carbon Energy Corporation. So this update is about two acquisitions. Both are still conditional, so they're not certain yet, but they seem highly lucrative. One little drawback is that they are going to issue new shares, so we have share dilution, and this will be 10% of the shares. And the reason why they do this, and we'll get to that later, is to keep their balance sheet healthy. I personally prefer to just use loans at this point because I know that they are very well, but I can also appreciate the fact that they stick to their own plan and they focus on staying healthy, because otherwise they could spin out of control and end up with too much debt. So personally, it would be better to have the debt for this part, but I like that they stick to their rules. They do this and they raise approximately $87 million, US dollars to be precise. And what does this mean? This means that on average the share price, I calculated that for you, I don't have a picture of it, it is about 109.6 pence per share as of today. So this made me question a bit like how new this information is, because we've seen like an insane rally from DGOC in the past past week basically, and past 2 weeks perhaps. So I think this information was already available to some people, but nonetheless it could also be that they wanted to issue these shares at this price and they couldn't how do you say that, announce this news before that moment, but I don't think that's allowed. So I'm assuming some of the information was already available, which makes sense with so many insiders that are shareholders, even though none of them bought. But yeah, I'm not that surprised by it if it will be the case. And final part, whilst maintaining a transaction adjusted net debt, transaction adjusted EBITDA of approximately 2.3. So nothing will change in this regard. They still have some wiggle room. That's also why I'm like, why didn't you? But okay, happens. Next, highlights of potential acquisitions. I'm gonna focus on the highlights mostly, and I will at the end I'll pick a few things that I read from when I went through the entire file, and I was like, okay, this is actually relevant for us investors, so we'll get to that. But first, they're gonna acquire Carbon for about $110 million, and the other one is $125 million. Keep in mind that when they announced this one, they actually said, okay, we can use this off a debt. And when they announced this one, including the other one, they were like, okay, maybe we need a little bit of equity, which is not that bad because I like the fact that they grow like this. And something to keep in mind with this is with potential aggregate contingent consideration of 35 million US dollars to be paid over a period of up to 3 years based on certain pricing targets should commodity prices rise. So what does this mean? Like both parties are aware that they can acquire these assets at a lucrative price, so pretty cheap, and that is because the gas price is very low. So they made a deal that we don't know yet, I believe, at least I didn't see it, that both parties could benefit from a rise in commodity pricing. and this is basically just fair play. And if the commodity prices don't rise, then we don't have to pay this part. And I like it because it's you get it at a cheaper price, and if you benefit from higher commodity prices, so higher gas prices, then you will already have a higher dividend and a higher revenue and all that because of all the current stuff that you own. So if it doesn't happen, you have it as a cheap price. If it does happen, then you benefit from all the assets that you already owned. Next information, focus on how much the adjusted net production will increase. 18 MB OEPD, which is about a 20% increase, which is pretty good. Like I based my calculations off of 15% growth, so this is already higher than that, so it's a great start. The only drawback is that it happened through equity, so it's not like a clean 20% production increase, but over time we will benefit from this. At least it's better than expected, but with the 10% decrease in equity value, you might say that this is actually a net increase of 10%. It would be a bit too easy, but let's stick to this for now. And it doesn't make it doesn't make it horrible or something, but I think the better way to look at it is actually to take 10% off of this amount, and then you get an 18% increase. But I will think about this some more, and I might do an update on DGOC with the calculations and how I view this compared to the equity increase, or the equity dilution, I should say. But right now I don't want to focus on that. I just want to focus on the acquisitions, or the potential acquisitions. So the third point, the midstream assets offer the potential for cost and operational synergies for the company. This is always good. What this basically means is that they are going to reduce their costs, which is great because they already have like an insane low cost price to produce. So yeah, great. It's great for the current assets as well. So you can't just see it as, okay, 20% increase in production. No, it's also a cost reduction, which will increase dividends over time as well. Fourth point is they take the next 27 months of hedging with $2.60. It's not the best hedge. It's about average for DGOC. Like they have 270 for this year, 253 or 59 for 57 or something like that for next year. So I think this is a pretty good hedge. It just makes sure that they can sell the gas that they're going to produce from these assets at a decent price. And the final point from this page is that if completed, the potential acquisitions are expected to add PDP reserves of approximately 122 MMBOE with an estimated pre-tax PV10 of approximately, and this is the important part, US dollars of 374 million, with the combined initial acquisition price reflecting an approximate 37% discount to PDP PV10. So PDP present value 10. What this basically means, they're going to acquire stuff for, let's say, 235 that you can see up here, and it is worth 374 million US dollars. So what does this mean? Their balance sheet will be like the intrinsic value of the balance sheet will increase, even though they are going to use debt to acquire this. What you could see because of this, and this is something very important to understand, is that because they can acquire it at a discount, they're going to realize a return in their income statement. And we have seen that in 2018 as well, when they were able to acquire something for a cheaper price. And what you're going to see is you're going to see this amount minus this, and this, perhaps. I'm not sure about this one, but for sure this and this. And that amount will be in their income statement as like a profit. Obviously it's not a profit, and this is something that I touched on in a previous video as well. Like I wouldn't see it as like cash that you get, but you get a profit based on the acquisition. So their income statement will blow up. Sorry, we will see a very nice profit this year because of that. But that is why we focus on the cash flow statement, because that will tell us more. And obviously this won't hurt the cash flow statement either, but the income statement is going to look a little bit better than the cash flow statement because of this acquisition. So that is something to keep in mind. And just, I think it's good to be aware that stuff like this can happen to an income statement, and that is why you shouldn't just focus on PE ratios and stuff like that. But that is all. I'm wandering off again. I just wanna give all that information to you, but I should do that in due time. So let's get to the next one. Adjusted EBITDA for the next 12 months from June 1st, 2020 for the potential acquisitions is estimated to be around 61 to 65 million. So keep in mind they acquire something for $235 million, could be $260, but this is what they're expected to be producing within an EBITDA. So that means that these assets will pay themselves off within 3 to 3.6 years, the acquisition. That's basically how you could look at this. Obviously there's the depreciation on the assets as well, but we tend to just look at what the I didn't take the balance sheet into account when I did the discounted cash flow method, just because of this, because I just don't want the assets. Yes, they're gonna milk the assets that they have on the balance sheet, so they're gonna reduce and then they're gonna turn it into money. That's basically what's happening. So I just rather focus on the free cash flow there. So we can expect this acquisition to be paid, acquisitions, because it's two, we can expect them to pay off within 3.6 years, which means that the acquisition has an return on investment, to easily put it, of about 25%, which is, I wouldn't complain if my current investment will give me a 25% return, so I don't complain when a company that I own will get a similar return while acquiring something. So that is basically how you can view that part. Next point is that the potential assets are estimated to have attractive a total cost cash of $6. I'm just going to round that up, including immediate realizable synergies, but not accounting for the longer term synergies that the company expects to realize through its smarter well management program and operational optimization. So they expect this to be the cash cost, and if you compare that to previous one, it's going to be a bit lower, but it's going to be in line with what we've seen so far. So we are not expecting to have an increase in cost because of this acquisition per barrel of oil equivalent. That is something that I should add to it, because obviously on a actual level we're going to see cost increase because revenues are going to increase. Final part of this is that the addition of these assets into the DGO portfolio is expected to drive, and this is very important, a 5 to 10% reduction in unit level base level of effort, and a 10 to 15% reduction in unit level general and administrative costs for the company. So what does this mean? That because they have acquired stuff and they are looking at this from a cost point of barrel of oil equivalent, they do not expect their administrative costs to increase with 20% as the production does. It will increase with a little bit, like let's say 5%. Same goes for the level of effort. So these are going to reduce, and what we will see is that the cost per let's say barrel of oil equivalent will reduce just because they acquire these assets. So this is positive for the current portfolio as well. And something that most dividend investors will be interested in is this part. The potential acquisitions are expected to be immediately accretive to the company's earnings and dividends per share. Added that to, based on the company's 2019 numbers, management's estimate for the assets, and an assumed 10% placing at market. So what management is expecting here, that even though we have a 10% share dilution, the acquisitions will be immediately increasing the earnings and the dividends per share. We cannot expect a 20% increase, in my opinion. I think we'll see perhaps a 10% increase in dividends Let's say right now it's 14 cents. Let's say it goes to 15 cents or 16 cents perhaps. I wouldn't go too crazy with the estimations there. As you know, I'm not a dividend investor, but I do like this business model, and that is why I'm in it. And what this basically tells us that even though we have share dilution, this acquisition will increase our dividends. Nothing to complain about in that regard. And just a fourth point on this page is no certainty that either will complete. So obviously these are not certain yet. So we cannot get too excited, even though I am quite excited. But because if they announce all this stuff, that it's more likely than not that it's gonna happen. And final part, just a quick look at it, is that they're gonna use 160 to 165 million loan to acquire this, so the debt will increase as well. But we've already seen that it's pretty interesting how it's going to look on the balance sheet. Sorry, I had to take a sip there. I'm just going on the row here. How do you say that? And this part I just want to focus on as well, that the people that acquire DGOC through the extra shares, they actually are eligible to receive the dividends of the past two that have been announced. I think just because you have dividends dates, it makes sense, but it feels a bit like it stings a bit in a way because yeah, they weren't shareholders in those periods, but neither were the people that are gonna acquire shares from people that are selling in the next 2 weeks. So it makes sense that this is happening. Just wanted to make sure that you know that. And yeah, they also mentioned that they will have a prospectus on the transfer to the main market on 13th of May, so Wednesday. So if something interesting is in that prospectus, I will provide you with an update as well. And it is still anticipated to occur on or around 18th of May 2020. So it seems a bit like they might postpone it for a few days, and it's also in line because I was expecting this to receive today, and that's why I was also checking the website several times today, but this announcement came in the evening. And the final part, and this is the only thing that I've highlighted in red as well, because this is basically I told you so, or called it from me, so let's read it. As a consequence of its admission, Diversified Gas and Oil plc is expected to enter the FTSE All Share in the September 2020 review. And this is basically what we have been hoping for. And this is what I called when they will move to the main market, they will attract more investors. And what does this mean? This basically means that they, in the September review of the FTSE All Share, it could very well be the case that DGOC is going to get included in that. And what that means is that all the index investors that hold shares that are followed, or all the fund managers, I should say, that are following the FTSE All Share, they will need to buy shares from DGOC to make sure that they keep on following it. So if they are included in the FTSE All Share in September, there will be more demand to the share in the following months, and if that happens, then we can see an increase in share price. Looking good. Then you have the CEO who mentioned a bit of text, but I noticed that I'm already at 19 minutes, so I'm going to focus on this part. Our unique business model, underpinned by low cost and low risk cash flow from US natural gas, enables the company to deliver shareholder returns at a time when many other industry players are unable to do so. And this is what we see in the whole industry, and we know from every news article that that America, US shale, basically, or American shale, is struggling to return value to shareholders and to actually stay afloat. So just another confirmation that DGOC is a relatively safe bet in a pretty volatile industry. So then there were, if you go through the announcement, there was the summary. Then you had like the details of both acquisitions, or potential acquisitions, I should say. There wasn't much new there, but there were a few things, 2 things in total, that I would be like, okay, I would like to mention this because it is important to distinguish this. And with the US listed company, what I noticed, and you can read it here, is that they have an initial 8 to 10% annual production decline. And why is this? Because they have relatively new wells that are only 5 to 10 years old, as you can read here. And yeah, they still have a steeper end of a decline curve, and afterwards they will decline with the 4% annual rate that we expect from DGOC. So it's kind of nice to see that they do not hold back in acquiring a potential, uh, in this case, company that already has newer assets, because yeah, if it's beneficial to them, they will do it, and they will apply the same smarter well management programs to this, and yeah, try to reduce the decline of production as much as possible. And then the final part, and this is something that I liked when I was reading about Carbon Energy, what their acquisitions, because something that I mentioned in the previous video as well, is that they are acquiring about 4.7 thousand or 4,700 miles of interstate gathering pipeline, primarily in West Virginia, and 2 active natural gas storage fields with approximately 3.5 billion CF of capacity. So what does this mean? This means that with they can transport about 90,000 MMBTU a day, of which approximately 80% relates to volumes produced by the DGOC. That leaves 20% for other people. So because they acquired this, they will have to pay less fees to other people that own these assets, in this case Carbon Energy. But besides that, they can also, for that extra 20% that they do not use, they can ask a fee. And this is what this part is about. The transportation of third-party gas on these pipelines, together with the 2 natural gas storage fields and large commercial, industrial, local distribution company connections, are expected to generate third-party revenues of approximately $12 million per year. This is interesting because this is an extra revenue that they can generate, and that is not related to production at all. I have to say, I don't think this is included in their calculations when it comes to the adjusted EBITDA, because they were focusing on the EBITDA or the production at that point. So this could be an extra. It could also be included, like I'm going to be a bit on the safe side, I'm going to say it could also be included in those estimates, but we will have to see. But regardless, this will also get them an extra revenue and it will reduce their costs. So it's interesting to read stuff like this. It's nice to see, because I'm not that knowledgeable about the gas industry. It's nice to be able to read all this information because you learn a lot from it. And a year ago, I wasn't interested in the gas industry at all. I was only looking at tech. I still prefer tech, but I don't own any tech right now. But regardless, it is nice to be learning about other industries like this. And yeah, I hope you guys are learning with me. I will leave a link in the description below to the update if you want to read it. And if you have any questions, feel free to let me know down in the comments below. I will include those questions regarding DGOC in the next video if you are quick enough, because I expect an update in about 2 days. I also had, that was actually what I had planned for today. I want to compare DGOC to an oil and gas company that is preferred by many in the US, and it's also a smaller company, and because of the way they have their balance sheet. It looks very healthy, so it's very highly priced because of that. So they have a low dividend yield. But I want to compare the two and see the differences and see why that company is that unattractively priced. But what I also want to do is, let's say DGOC transfers to a company like that in 10 years. That means that it's going to be relatively safe compared to all the other gas and oil companies out there. And that could mean that it would be valued higher, meaning that we could have a bullish thesis that could even be better than the 10 bagger that I mentioned before. So I wanna take you. I still have to do the research for it, but I do expect that one to be up and running in the next, let's say, 7 days somewhere. Should be interesting. And for now, if you like this video, like please leave a like. It really helps the channel and also motivates me to find another DGOC out there somewhere. Probably gonna take me another year or so, but who knows when I'll find it. And to share it with you again. So if you enjoy these kind of updates, please leave a like, and yeah, let me know down in the comments as well, because it's nice. It's nice to read stuff like that. Yeah, I'm doing it for you, so it would be great to just to read that it is appreciated. And for now, I'm at 25 minutes. Sorry for the long video. I hope you found it interesting, and I wish you a great evening.